Welcome to Retirement Revealed. I'm your host, Jeremy Keil, and we're here to turn your retirement savings into retirement income. Today, we're talking with Martin Baily about how to fix America's retirement system. Martin is the former chairman of the Council of Economic Advisors, and he just wrote a book, The Retirement Challenge: What's Wrong with America's System and a Sensible Way to Fix It. I think we can all agree the retirement system is facing some challenges. So let's learn from Martin how we can face those challenges head on. Martin, welcome to the show.
Thank you very much. Yes, I mean, we used to have a system which was based on pensions, where most people either had pensions or we were trying to change the system in a way that more people had pensions. But that's really changed. And now American families really have to manage their own retirement. And that's a big reason we wrote this book, because I think people need help doing that. They are, a lot of them, some of them are okay. Some of them feel like they're sinking, but a lot of people are very nervous about, do they have enough money? Are they going to be able to manage as they get older?
Yeah, it's interesting because you write in the book that the system is outdated, as in it needs some new things in there. But it seems like a lot of the economists want the solution to be, let's bring back the pensions. So that's a interesting kind of juxtaposition. How do you say it's outdated? And then also, I believe I'm inferring that having more pensions actually might be part of the solution.
Well, there certainly are economists that think that's the right answer. And, you know, I can see why. It in some ways, having a pension is a wonderful thing. And the people that I know, there are quite a few people, obviously, in Washington that have pensions because the federal government still has pensions. And some of the other organizations in Washington have pensions. But these days, it just is not going to happen. We are not going to have a big rise in the coverage of pensions certainly among private sector workers. And even the federal government is scaling back its pensions to some degree. And I think state and local employers are also doing that. So I just think it's unrealistic to think that we are going to go back to the old days of pensions or effectively have more pensions. I will say that one thing we do strongly support is putting Social Security on a better footing. So Social Security is a pension. If you've worked a number of years, you do get money every month until you die. So we all have that, or almost all of us have that. So there is that basic guarantee. But the idea that that's going to get a lot more generous, I think, is also realistic. So in our current political environment, whatever you may feel about the desirability of pensions or about making Social Security a lot more generous, we really think that's just not realistic. It's just not going to happen.
Yeah, it's interesting. I talked to clients, people who have are retiring, they're investing, and sometimes they say, "Oh, I hate annuities," and I ask them some extra questions, and they say, "But I love my Social Security and I love my pension," which is just really funny because Social Security is a pension. Pensions are annuities. So they love the annuities that are basically somewhat given to them. I mean, not quite, but they love the annuities they're forced into. So I appreciate you kind of mentioning how Social Security works like a pension. And of course, I think you might agree that pensions are annuities, or at least work like annuities. I'm going to get back to some of that, but you've mentioned a few words already: economist, political, Washington. You've got a lot of connections there. Tell me more about that and more about yourself.
Well, I've been an economist in Washington since 1979, so a long time. I spent part of that period in the 1990s as a member of the Clinton administration. I joined the Council of Economic Advisors, which is a small group, a very small agency, but a very important one that really has quite direct contact with the President of the United States to talk about, give advice about economic policy. It was set up after World War II as a sort of group of independent economists to give advice to both the president and other members of the administration. So I joined in 1994, and I was there for 2 years as a member of the council. And we had a lot of interesting times. President Clinton it was very interested in economic issues, and so we were able to have a lot of meetings in the Oval Office, and we also were part of the so-called NEC, the National Economic Council, talking about economic policy. Then I left. It's quite normal for economists to have a 2-year stint, so I had a 2-year stint there, and then I left and joined McKinsey and Company, the big consulting firm. I had been an academic prior to that. So I was there for, I think, about 3 years, and then was asked to come back to the administration as the chairman of the Council of Economic Advisors in the last 2 years of the Clinton administration. So Laura Tyson had been the chairman when I was there. Joe Stiglitz, a well-known economist, succeeded her. And then Janet Yellen, who has had a very distinguished career, both at the Federal Reserve and now she's Secretary of the Treasury. So she followed Joe Stiglitz, and then I followed her as chairman of the council. And I have to say, those were pretty good times economically. The economy did very well in the 1990s. We had low inflation, we had strong growth, wages were going up, incomes were rising. So that was a good period. I don't know how much credit we can claim for it, but it certainly was an excellent period for the economy.
Yeah, I like how you say, I don't know how much credit we can take for that, because it seems when we talk to investors, retirees, they like to add a lot of blame to the politicians or to economists and things like that. And I've got a good feeling a lot of it is just luck or a coincidence of, well, Bush did this or Clinton did that or Obama or Trump. And, you know, the U.S. economy especially is so large. One person or a few people, I don't think, can super materially change it compared to the hundreds of millions of Americans that are making the economy run. But at the same time, I appreciate you mentioned kind of the, I guess, political connections. Correct me if I'm wrong, but I think I don't know if it used to be called this, or at least there's a study of a field called political economy. And I do appreciate that phrase. You don't hear it too often, because if you really think about it, when most people are saying, here's what's wrong with the economy, all they're doing is talking political stuff. They're not talking like supply and demand and surpluses and deficits. They're talking political kind of stuff. So the idea of political economy, I think, is certainly worth exploring of what are those connections, and what can the politics do to the economy, and just, or what they can't do, because a lot of times I think they can't necessarily do that much.
Well, let me say a couple of things. One is that I don't think you should dismiss altogether the role of policy. I think there were a lot of good things that were done during the Clinton administration, and we did end up with a balanced budget. I think that was helpful.
Haven't seen that for a while.
And haven't seen that for a while. And I think Clinton also supported monetary policy. Alan Greenspan, whom I got to know quite well at that time. And so I think there were some things that were done right that helped the economy. But as you say, there was some fortune in it, in that we got a very strong burst of technological change, which helped boost productivity and economic growth. And I think we certainly supported that, but it did come primarily from the private sector. The other thing I want to mention is that my co-author on this book, Ben Harris, and he has been, he was in the Obama administration and was the principal economic guru helping Joe Biden when Joe Biden was the vice president. And he then rejoined when Joe Biden became president. He rejoined the administration, this time in the Treasury, and he's been an assistant secretary for policy in the Treasury, really helping Janet Yellen as they faced a number of quite substantial economic challenges. He's now left the administration, so he's helping to promote this book. And he really was the retirement expert that I wanted to work with as we worked on this project, which we did initially as a big project through Brookings and the Kellogg School at Northwestern. And then we wrote the book together. But he certainly has very good connections on Capitol Hill and in this administration. And you're right, political economy is important. We like to, focus on what we think is the sort of objective reality of what economics says. But we are also, you can't get away from the politics. One of our recommendations is that we absolutely need to put Social Security on a stronger footing. And that's really a political decision.
Yeah. And in your book, you gave us a bit of hope, and then also too, referencing kind of the 90s and Clinton era there, you gave us some hope that both political parties both want a stable retirement system. So where do you think Republicans and Democrats can agree when it comes to fixing America's retirement system?
Well, certainly our politics at the moment is very divided, and with so much energy being put into things like dealing with the debt limit, which is unfortunate that we're having to spend time really on that. That should be done routinely. But I think if we can get past that kind of divisiveness, I know there are many Republicans that hear from their constituents about the need to help them out with retirement. I think helping people to get access to 401k plans. Now, 401k plan, as I think most of your listeners know, is one of the ways that people save for retirement in the private sector. There are other very similar plans, 403b plans, and so on, that we don't have to go through that. But these are basically ways in which you can contribute to a retirement saving through your employment, and you get a tax break for doing that. So that's one of the biggest things that we have to help people accumulate money for retirement. And at the moment, only about a half of workers have access to 401k plans or similar plans. And so we need to expand that. We need to give encouragement to employers to offer that. We need to make those available to people who are perhaps not actually employees or not in a stable employment relationship, so that they can also contribute to a retirement plan. And some of that was done through the so-called Secure Act or Secure 2.0. And that did provide some help to people saving for retirement, but probably didn't do enough. And so I would like to see, and I think we can get Americans, of both political parties on board with improving access to those retirement plans. There are now 6 states and a city, I think it's Seattle, that actually offer similar plans. They're not obviously 401b plans, but they are very similar to those, so that people who don't have a retirement plan through their employer can actually sign up for one that's then run by the state government or the city government. That's not ideal, but we think that's an improvement. So helping more people get access is a big deal, and I think both parties can agree on that.
Yeah, it's interesting because the people that talk about the money in the 401ks, they already have the money, they already have the access. And I think just personally speaking, you can kind of forget about the other folks that don't have the access, which like the stats don't lie. Half of Americans don't have access to some sort of retirement savings plan. You could argue maybe the Roth or IRA, but it sure is easier to do it through a payroll deduction. I've always thought when it comes to programs and just even in your own personal life, make the best use of what already exists before you think of something new. I'm curious your thought. I wasn't planning on asking this, but I've got just your thought. What's your thought about kind of opening up access to that thrift savings plan? There's already a 401k with a super cheap administration cost out there that the federal government, I think, could easily, with a policy change, just allow everyone, or maybe just the people without access, to go into it.
Well, we do in the book actually support that.
All right, great.
So we're on the same page as you are, and I think that would be a very big deal. As you say, people can open their own IRA accounts, and so they're not prevented from saving for retirement or even getting some of the tax advantages, even if their employer doesn't do it. But I think that the workers that don't have 401ks, it's there's a barrier to doing it, and it's a little bit difficult to do, and they don't always understand the provisions and so on. So opening up the thrift retirement plan would be, I think, a wonderful thing to do, and a lot of people would participate in that. Now, the pushback that you get is that people say, well, we don't want the government owning private companies. We want to make sure that our private sector remains private and not under the influence of government. So we don't want government administrators voting shares or really having substantial ownership in private companies. But I think it's possible. I mean, the TSP is managed separate from the government, and we could, if we opened it up, we could allow that to be managed by private investment companies. The ones that already doing that. People like TIA, and I don't want to single out any particular company, but there are a number of very reputable companies that run 401k plans. So they could run the one for the federal government that was open to everybody. And so, it would be really kept at a distance from any kind of policy interference. But that has been, I think, the obstacle, that people look at opening up TSP and they say, well, we don't want the government to be too involved with the private sector. But I think we could overcome that problem.
Yeah, to me, that sounds like an excuse not to get something done. But I think, like you said, you can overcome it. You mentioned Social Security a few times. How would you go about fixing Social Security?
Well, there's a lot written on that, and so we don't make it a major emphasis of our book, except to say that it does need to be done. But since you asked me the question, I'll say, look, there are some people that we think don't get enough. I mean, there are some widows whose husbands didn't make much money when they were alive. I say widows, obviously sometimes they're widowers, but women do on average live a little bit longer than men. So there are more widows than widowers, and that really don't have much from Social Security, and don't have much else to support them. So we think for them, maybe there could be some small increases in benefits. We could also think there should be maybe some trimming of benefits at the upper end. So there are some people who are quite wealthy, who are receiving really quite generous benefits. Maybe both husband and wife worked, so they may be collecting $90,000 or $100,000 a year from Social Security, and they've paid in. There's nothing that's a scam about that. They deserve to get the money. But perhaps if we wanted to save a little bit, we could scale back those benefits just a bit. We don't want to scale them back too much, because people have been paying in their entire lives, and they have a right to get a decent benefit out of it. So one thing that could be done is some adjustment on the benefits, maybe trimming them a little bit at the top end, maybe being a little bit more generous on the bottom end for people who've don't have much else to live on, but whose they or their spouse worked for many years and deserve to get a bit more. And then after that, it really comes to the question of, are you willing to raise taxes a little bit? And I am. I think we would need to do that. It wouldn't have to be a very substantial increase either in the so-called FICA tax rate, the amount that you pay as a payroll deduction from your salary, or to increase the top end. So at the moment, FICA taxes are only paid on the first, I forget how much it is, 100 and some thousand, and then after that. So you could raise that limit a bit, or you could increase the tax rate a little bit, the amount paid by employers or the amount paid by workers, or both. It wouldn't have to be a big change to put Social Security on a stronger footing. The people make a big deal about Social Security is going to go broke, and yes, the trust fund is going to run out. But the Social Security problem is not the most serious one that we face together. Actually, the Medicare problem is, I think, a bit more difficult than Social Security. So modest adjustments on the provisions, the tax rate, and on the benefit side would solve the Social Security problem. Now, remember, we did this back in the 1980s. The so-called Greenspan Commission came in and made some adjustments, and they did adjust taxes. They also adjusted the age of retirement. You could still collect benefits at 62, but the time where you receive full benefits got moved up to around 67 now. So we could do that. I'm not so enthusiastic about that, because people who've been, carrying boxes for 30 years, or, working at Walmart for 30 years, we don't want to force them to have to retire at 70. They need to be able to retire in a reasonable way. Hopefully not 62, but certainly, maybe 65 or so. So I'm not supporting raising the retirement age, although that may be one of the things that's done if we do get around to solving the Social Security problem.
Yeah, I think the easiest solution is just to raise the retirement age. And it's always been the logical solution to me, until I've just been reading a lot of articles recently where I'm kind of trying to find a different perspective that I've had. And the most convincing perspective I've seen of why not to raise the retirement age is that difference between the top 10% in income and the bottom 10% of income. The average life expectancy difference there is 12 years. And so it's simple for me, a financial advisor in good health, to say, oh, raise the retirement age. It's just a logical thing if you compare it to the 1930s. But kind of the dispersion of who that affects is just going more towards the people that need it the most.
Well, you put your finger on it, and so you obviously know what you're talking about here, and you're absolutely right. So at the moment, Social Security, in a way, is unfair to people at the bottom end. Obviously, they get smaller benefits, but they also don't get benefits for as many years. They tend to die much younger than people, upper income folks. So that's why another reason why I'm against really raising the retirement age. In a way, you say it's logical. We're living longer, we're healthier longer, but that's not true of everybody, and it's particularly not true of lower income individuals.
Yeah, you got it. Well, one sentence I found interesting. Well, you said in your book, you mentioned that there's a solution that Americans need to trade part of their 401k for insurance products, which I think is just a way to say annuities. What types of annuities make the most sense in retirement?
Well, a standard annuity, which you buy, you can buy it, on installment before you retire, or you can buy it when you retire by allocating part of your retirement portfolio to buying an annuity. And a standard annuity will start to pay out, and will pay you regular payments, maybe monthly, maybe quarterly, depends on the company issuing the annuity. And so you get essentially a pension. So we mentioned this earlier, that people love pensions, but for some reason they don't like to buy annuities. Why is that? Well, When it's a pension, it feels like, oh, that's someone else giving me that, so that's great. And Social Security is something that I get from a government program that I've paid into, so that's great too. If it's an annuity, well, you have to give up control over some of the money that you've accumulated in your retirement account. And people don't like doing that. They want to be able to control that money. And I understand why. People are often a little optimistic about how good they are at retirement investing. So they think they can invest well and make choices. And I like this company or I like that company. And sometimes they make bad choices there, but they don't like to give up that choice. And so if you buy an annuity, you've given up the option of making those investment decisions yourself. And all I would say there is that ordinary people, and I include myself in this, I'm a PhD economist, but that doesn't make me a great investor, unfortunately. And so giving up that ability to choose this company or that company, or maybe pull your money out of the stock market when you think it's going to fall, those choices probably aren't so great. It's very easy to make the wrong choices. I've made a few wrong choices myself. So I would say probably that's not a good reason to. It's not a reason to not buy an annuity. The other reason people are reluctant to buy annuities is that interest rates have been very low. So the amount that you get, the payout from an annuity, those have been rather depressed. And the payment levels have been sort of coming down or came down as interest rates came down. Now, just lately, of course, interest rates have gone back up again. And so that does make, at least for now, makes annuities look a little bit better relative to investing in the stock market. But also keep in mind that by investing in annuity, you take away the risk of the stock market going up and down. And we've seen that in the last year or two, that the stock market can go up and down. And if you're relying on your investments to live on, that can just be very scary. So buying a regular annuity is something that I think many people should consider. I think that we need to encourage financial advisors to be more positive about annuities. I think another reason people don't buy annuities is financial advisors. They want to keep the money in the investment account because they get paid based on how much money is in the investment account. So they often don't tell people, oh, buy an annuity, or they don't talk about the advantages of buying an annuity. So that's one problem we have. In the book, we also talk about something called deferred annuities. And when we talk about that, sometimes people roll their eyes. This is something that economists really think are a great idea. But it's something that's quite difficult to convince either financial advisors or retirees to think about. So a deferred annuity is really pretty much an insurance policy. So you pay a certain amount of money when you retire, whether it's 65, 70, whenever you retire. So you buy this deferred annuity, but you don't get anything back for a number of years. Perhaps you don't get anything back until you're 80 or 85 years old. So what you're buying is an insurance policy that pays out if you live a long time. And that actually is quite hard to persuade people to do that. People say, well, I'm not going to live that long, or, won't worry about that when it happens. But we think if it were possible to persuade companies to start writing these deferred annuity policies, and retirees to buy some of these deferred annuities policies, even better to have companies offer both annuities and deferred annuities as part of their retirement package that they offer to their employees. That could actually be something that would be quite helpful, because that's where retirement poverty actually occurs. People have enough money and they manage just fine but then they get to be 80 or 85 years old and they run out of money. So that's a moment where you want to make sure that you're well provided, because at that age, you can't go out in the labor market and get a job at 85. That's not really feasible. So you want to make sure you're well provided for in very old age.
Yeah, there's so much great wisdom you share with there. I'm thinking right now how great the opening up the thrift savings plan TSP would be to Americans,
Yeah.
because
Yep.
they get access to it. I know for a fact that it's very easy to turn part or all of your thrift savings plan TSP into an annuity, into a lifetime
Exactly.
income on there. You call them regular annuities. I like to call it a payout annuity, because the focus is really on getting the highest payout over your lifetime. And just to think through of that regular annuity or the figured income annuity, two of the biggest worries people have going into retirement is I will outlive my money, or I will kind of run out of money.
Exactly.
Two different ways to, it's slightly different. But that deferred income annuity, if you live a long life and you're worried about outliving your money, well, that comes in to help you out. And that regular annuity, it's easy to see I gave up my control of this money. What's less easy to see, but is very much there, is when you have more of an annuity, more of an income coming in, it takes the pressure off the remaining parts of your investments. And your worst case scenario, if you're worried about, I'm going to run out of money, what if my accounts go to zero? Well, if you have more annuities or more some sort of payout, your worst case scenario you can probably live with. If you don't have
Exactly.
those annuities or income payouts, whatever it is, wherever it's coming from, your worst case scenario might be a really bad case scenario. So it can kind of help in a lot of different ways.
Well, it's a pleasure being interviewed by you, because you're obviously very knowledgeable about this subject, and you're giving quite a bit of wisdom on this subject yourself. But that's right. And so an annuity plus a Social Security payment, or having a deferred annuity when you get to very old age, those things I think can be important tools. I'll mention one more thing, though, that is important for retirees. A surprising number of retirees, who these are not the poorest ones. So these are people who've maybe accumulated $500,000 or $1 million perhaps in a retirement portfolio, maybe more, and they get to retire, and they don't spend that money. They don't. Obviously, if it's has been in a 401k, then there's a compulsory withdrawal. I think now starts at 72. But a lot of people only draw out the minimum, or they don't draw out their savings in retirement. And if we don't know exactly why that's the case, there hasn't been research that I know of that will tell us definitively what the answer is. But it looks as if people are not spending that money because they're worried about the need for a nursing home or in-home care, intensive care as they get older. So people see that it's very easy to become frail as you get older, and you can't climb stairs, you can't do things that you used to be able to do, and so you need someone to help look after you, or in the particular case, you may need to go into a nursing home, or something for dementia care if people suffer from Alzheimer's or another form of dementia. So people are very worried about that. They don't want to be a burden on their children. They don't want to be a burden on their spouse. And so they hold on to that money, which could provide them with a much more comfortable retirement. And they sort of hoard that money out of concern that they might end up needing to go into a nursing home or get very intensive care. So that's another issue we talk about. It's a very tough issue. There is no easy answer to this. For many people, the backstop has been to go into a Medicaid nursing home. But there is a concern that Medicaid is actually going to be cutting back on availability of those nursing homes. So that's even another reason why people are concerned about that. So we think one of the things that needs to be done is to try to revive the insurance market so that people can actually buy an insurance policy which will pay off the cost of a nursing home, or at least pay off a substantial fraction of the cost of a nursing home or in-home care, to have someone come to your home and help you, because that's, I think, is the other big concern about retirement.
Yeah, it's interesting to bring that up with the reason a lot of people might be holding on to their money. It's the thought that, what if I need it later on? Two thoughts of, what if I need it later on because things change, I need more income. Well, you mentioned the deferred income annuity. Or what if I need it later on because I have a long-term care health situation? Well, there's that long-term care insurance. It's funny that some people think that insurance is kind of a burden, but the insurance products, the deferred income annuity, the long-term care insurance, really it's a freedom maximizer. If you've got the long-term care insurance, you should be able to have less worry about the need for coming up the money yourself. If you've got the deferred income annuity or enough payout annuities, some manner of those, you should have less worry of, what if I live a long life and don't have enough? And that should give you more freedom, more comfort to enjoy some of your money now, to spend some of your money now. And I think that is one of the many perplexing things that economists can think about with retirees, is why aren't they spending this money? There's a certain subset that isn't spending it. I'm nerding out a bit on my economics with you, Martin. I appreciate that. And you might like some of these terms I'm about to use, but I think economists look at, well, aren't humans pleasure maximizers? Shouldn't they just be taking their money to maximize their pleasure? And I don't think that all people are going to be, what my term that I came up with while we're talking here is comfort maximizers. I think some people just want to maximize comfort, and there's a lot of comfort, a lot of utility, to use an economics word, in just having the money. It's not necessarily what the money could turn into. It's more of what it represents. And I think it represents comfort and safety. And so a lot of economists look and say, what's going on with these folks that don't spend the money that they sacrificed for? Well, they're maybe sacrificing more for the utility of this comfort. I've got this ability to feel safe and feel comfortable by holding on to the money. That's my thought on it.
Well, your thoughts are very excellent, and I appreciate you providing them in this discussion. The Probably one of the problems, though, is that the insurance markets are not working the way they are supposed to. So buying a long-term care insurance policy is very expensive if you do it as an individual. And most employers are not offering group policies. So that actually there's some danger that that insurance market will actually disappear, because it's become so expensive. Fewer and fewer people buy those long-term care policies. And so fewer and fewer companies offer them, and the only ones that do offer them at very high prices. And these insurance policies also, many of them, they reach a limit, so you can actually, they don't provide full security, because maybe you're in the nursing home for 5 years, and then after that the money runs out. The insurance policy says, well, you reach your maximum, or they only pay for a fixed amount of dollars, which doesn't really cover the cost of the nursing home. So we have a problem in our insurance markets, and that's a big part of what our book is trying to say, is that the insurance markets aren't working the way they should. And that's true to some extent for annuities policies as well. A lot of annuity policies aren't really the kind of annuities that you and I were talking about.
That's right.
They're policies that are set up to allow affluent people to save more. And there's nothing wrong with affluent people saving more, but we want to make sure that there are some regular annuity policies, or payoff annuity policies, as you put it. And And similarly, we'd like to see a revival of long-term care insurance. And actually, if we had that, it would take some of the expense off the federal government, because at the moment, the federal government provides a lot of backstop care in Medicaid nursing homes. How do you do that? Well, I think it would be worthwhile for the federal government to provide some kind of subsidy for long-term care insurance to make it a bit cheaper. And I think that would be a good investment. I think they would get their money back on that. Also, they could encourage employers to offer those long-term care insurance policies and annuities as part of their retirement packages, and provide counseling to their workers to say, these are some of the advantages. And as you exactly said it right, these are freedom policies. They're freedom from worry about having to go into a nursing home and the cost of that. They are freedom from worry about living too long and running out of money. And they allow you to enjoy your retirement free of some of those kind of worries. So an important part of the recommendations of our book is to try to revive some of those insurance markets and make them work better.
Yeah, excellent. Well, I appreciate you writing the book. Appreciate you nerding out with me on the economics. I love talking about this. I think you've expanded a bit my thinking, but also helped me kind of round out and speak what I was maybe having right around my brain there. So I appreciate you doing that and coming on the show, Martin. I've got one more question for you. Before that, tell us, what's the best way for people to reach out to you or perhaps get the book?
You can get the book from Amazon, and the book is The Retirement Challenge by Martin Baily and Benjamin Harris. So please do buy it. I hope you like it. I hope you send in some many-starred reviews. That would be great for us and great for our sales. But you can reach me at the Brookings Institution. I cannot promise to answer all your questions. We don't give specific investment advice. So we don't tell people, okay, what should I invest in, either when they're saving for retirement or after they retire. Go to go to your financial advisor, watch one of Susie Orman's shows or something like that. And there are a number of good people. Make sure that if you get an advisor, make sure you know how they're being paid and they're not being paid excessively, because sometimes advisors can steer you into products which are good for them, not always the best for you. Yes, but I'm available at the Brookings Institution, and I really appreciate the chance to be on your show and getting to meet you on this interaction.
Yeah, you got it, Martin. And we love education. You're clearly focused on education. And what I love most is that this isn't highfalutin ivory tower kind of stuff. You've really broken it down into how people can approach things in their personal lives, and then really some common sense ideas that need to come about on the policy side. What we're going to do, first 3 people that email me, podcast@keilfp.com, we'll send you out Martin's book. So we'll get that book from Amazon delivered right to you. Email me at podcast@keilfp.com. Yep. I love education and giving away books on our podcast. Everyone else, we'll have links in the show notes on how to get to Martin's book there. All right. Final question. Tell us something about yourself that few people know about. And remember, this podcast is rated clean.
I grew up in England, and I've been here now since 1968. So I've lost my accent. And when I go back to England, people think I'm an American, which I am. I'm an American. And of course, I've been in the administration. But I grew up in a central part of the country in Birmingham, so that makes me, in British terminology, a Brummie. And so I'm proud of my British ancestry, but I'm also a very proud American. And thank you for having me on your show.
Yeah, it's been great. Thanks for coming on the show, Martin. And thank you for listening to the Retirement Reveal podcast. We believe if you know more about your money, you will feel better about your money, and you will make better money decisions.